Welcome back. You're with us on Closing Bell. We have Nikhil Ranka of Nuvama Asset Management now joining in to give us his sneak peek into 2025 and what the market may have in store. Nikhil, good to have you on. Thanks for joining in. So it's been a tough Q2 the last couple of months, right? We've got so much of negative news flow from earnings to GDP slowdown to, government capex not as strong as one would have hoped for, at least in the first half. But now as you look at 2025, let's start with the headline call first. Range bound, maybe some more downside, or will the market surprise us all and take off?
Well, good afternoon, Surabhi and Reema, and thanks for having me on the show. So the last time also I was there on the show, we were at close to 23,500 levels. We were positive on markets from those levels. The markets rallied almost to 24,800, and then we've seen this fresh round of selling from FIs. Post the guidance from Fed of only 2 rate cuts in 2025. Now, if you look at sort of last quarter or the quarter which is going on, you have to see we've seen the largest selling by FIs in a single quarter that has happened in the history of Indian capital markets. We had in excess of $20 billion of selling. We had record primary market issuance. We had close to $3 billion of issuance in the month of December itself. And to top it, we have one of the slowest earnings growth that we have seen in the last 10-12 quarters. But if you look at it, my sense is the commentary should turn substantially better as we head into Q3 or the new year in that sense. We should see the earnings for Q4 should be substantially better because December, the festive season has been good for a lot of companies. In terms of FI flows, with the $20 billion of selling that we have seen, the sort of overweight of India in the MSCI emerging market would have come down substantially. And therefore, the incremental selling that we will see from FI should be far lower as we head into the next quarter. And therefore, our view is this range of 23,300 to 23,500 should prove to be a very good support for the markets. And we should head on an upward trajectory from here on. My view is we should be closer to 25,000 levels, closer to March, April.
Nikhil, hi. Afternoon. This is Reema here. In terms of constructing portfolio, is it time to look at some contra bets? Stocks and sectors which haven't performed in 2024, like specialty chemicals or metals have been fairly beaten down. Is it time to look at any, would you have any contra bets or consumption, for instance?
So, Reema, I would say that steel can have a very good tactical rally over the next 2-3 months. As you have been also highlighting, the DGTR has recommended investigation into dumping of steel. And the expectation is that there could be a 10 to 15% anti-dumping duty that could come for flat products, and participants have recommended a period of 4 years. Now, if you look at HRC prices, they are at closer to 50 to 53,000 rupees. And even if there's a 10% sort of anti-dumping duty that comes through, then obviously there can be a 4,000-5,000 rupees of steel price uptake. And that should provide a floor to the profitability of steel players for the next couple of years. So both earnings as well as multiples can see some sort of re-rating for the steel sector. Consumption, I would say we are playing more rather than consumption because the commentary has been a bit subdued from a lot of FMCG guys. And therefore, we are more tactically positive on OMCs and aviation. If you look at the OMC space, as compared to the last quarter, refining margins have increased to $3. Crude has come down $12-13 as compared to the last quarter. And therefore, the gross marketing margins on both petrol and diesel are now close to 9 rupees. And if in the supplementary grant, we do get some compensation for the LPG losses, which OMCs have suffered in Q1 and Q2, then going ahead, Q3 and Q4 can be very bumper for OMCs. So aviation and OMCs are the two sectors which we feel should do very well going forward.
Okay, OMCs and aviation, these are some of the areas you're liking. Also, in terms of market cap based selection, while the narrative has been, by large caps, a lot of mutual fund managers have been saying that there's more valuation comfort there. But this FPI selling is really hurting the large cap space. So overall speaking, I mean, would you have greater propensity to go beyond the Nifty 50? Or are you looking to still pick up these, large cap bargains, which have fallen quite a bit?
So, Surabhi, if you look at the premium of the mid-cap index to Nifty 50, that is now at almost close to 30%. And this has been amongst the highest that we have seen in the last 5-8 years in that sense. Now, the point is because we have seen so much of selling from FIs concentrated in one particular quarter, and most of their holdings have been on the large cap side, we have seen large cap bearing the brunt of the current fall that we have seen. And therefore, in terms of risk reward, clearly we feel that large caps are a much better place to be in right now as compared to mid caps. However, in mid caps, you have to be very, very selective. Select stories where you will see 30-35% earnings CAGR in mid caps, and where there is a strong business mode will continue to do very well. But there are some pockets of fraud that have developed on the mid-cap side. And therefore, one has to be very cautious on those stocks and sectors where you see, it's very difficult to meet earnings expectations that have got built into the mid-cap space.
Okay. Any other sectors? You mentioned aviation, you mentioned oil and gas. What about financials? What are you buying there?
So financials clearly have got into the value zone now. So MFI, if you look at it, Q3 should mark the peak for the stress that we see in the MFI book. The commentary from most of the sort of companies that we have spoken to does indicate to us that Q3 will be far worse as compared to Q2. But that should also mark the peak of the stress for these players. And a lot of stocks there are now available at less than 1 times price to book. So if somebody has a 9 to 12 month view, because stocks may not do anything in the next 3 to 6 months over there, but obviously markets will start pricing in the recovery 3 to 6 months ahead. And therefore, somebody with a 12-month horizon should start looking at some of the MFI picks. Even large cap banks, if you look at it, valuations have now been below 1 time, 1 standard deviation below their historical levels. And therefore, even there, my sense is we should start to see some sort of uptick. On the cautiousness, I would say auto is something that you will have to watch out for, because if we have a 3,000-4,000 uptick in steel prices, then clearly margins will take a hit for auto guys, because demand has not been very strong post the festive season in autos. And it will be difficult for companies to pass on the entire 4,000-5,000 rupees of price hike that will come through in terms of commodity prices. And therefore, there could be some sort of margin pressure that we will see in the coming quarters on the auto sector.
And a quick word on IT. Q3 could be on the softer side, but thereafter Q4 onwards, or do you think 2025 we will see a very good recovery? Because IT has been subdued in terms of pure fundamentals in numbers.
So, Reema, if you look at it, Q3 and Q4 typically are soft quarters for IT because we see a lot of furloughs in this quarter. And at least for the larger guys, our expectation is the CC dollar growth should be in the range of 0 to 1%. For some of the mid-cap companies, it could be closer to 3-4%. But in general, if you look at valuations, a lot of IT stocks, large cap IT names used to trade between 18 to 23 times 1 year forward earnings. And today that number is almost close to 26, 27 times. Those sector is therefore at a 10 to 15% premium as compared to historical averages. And till the time we do not see traction in order bookings or revenue growth, I would say IT will more be a range-bound trade that we will see, because we've not seen significant deal wins getting announced from the large guys in the IT space. So the view is that IT will be a bit range-bound for the time being. And then as we get clarity on FY26 for most of the companies, that is when probably we will start to see the next leg of up move in IT companies.
Nikhil, thank you very much for joining us this Monday afternoon. Need to get into a break. As always, on the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We'll also get you a few BTST calls from our technical experts.